Now, US President Donald Trump said that he plans to start his reciprocal tariff push with all countries, curbing speculation that he could limit the initial scope of the levies. He said that he couldn't care less if firms raise prices in response. Now, Trump in his second term is also least worried about the deep sell-off in global markets. Stagflation fears are rising and will constrain the Federal Reserve's ability to cut rates further. A roller coaster quarter for markets came to an end, but Trump's policies and stagflation fears are driving investors out of riskier assets. European stocks are beating US equities by most on record. Japanese stocks are in a correction and gold is at a fresh record high. The US administration is expected to unveil a broad slate of so-called reciprocal tariffs, as we've been talking about, that is looming as the next potential body blow for the markets. Amidst those fears, stagflation emerges as the winning bet. Reciprocal tariffs will hit US trading partners who've enjoyed strong trade surpluses over the years. Now, the United States had its largest trade deficit with China, $295.4 billion last year. The next is with the European Union, with America's trade deficit at $235.6 billion in 2024, followed by Mexico at $171.8 billion, and then Vietnam at $123.5 billion. US trade deficit with Ireland and Germany stood at over $80 billion. Taiwan, Japan, South Korea and Canada accounted for over $60 billion. Trade deficit with India, Thailand and Italy were over $40 billion last year. US deficit with Switzerland stood at a touch below $40 billion in 2024. Comparatively, Malaysia, Indonesia, France, Austria and Sweden had a smaller deficit with the United States. So with Trump calling for reciprocal tariffs, all those countries are likely to face equivalent US import levies. The countries that are likely to be spared on Trump's so-called Liberation Day are the Netherlands, South and Central America, Hong Kong, Australia and the United Kingdom. In 2024, America had a trade surplus with those countries. All right, and for more on this, we're now being joined by Mark Matthews, Managing Director at Bank Julius Baer & Co., live from Singapore. Thank you so much for joining us on a World Business Watch. Now, to begin with President Trump's plan to impose reciprocal tariffs on over 20 countries, how do you think this will impact the US economy?
I think it will impact inflation, but the US economy is quite insulated to global trade because it's got such a big domestic economy, and it has a very large service sector, and many of its companies that operate in the service sector sell products around the world. So it actually has quite a large service sector surplus, even though it has a goods sector deficit. So the impact will be primarily on inflation, and I don't think it'll be a terrible inflation shock, but I do think inflation will go up high enough that the Federal Reserve won't be able to cut interest rates a lot this year. Maybe just one time this year. We're forecasting one rate cut in September.
All right. Just to expand on that, as I mentioned earlier, stagflation fears are rising. How will this affect the Federal Reserve's ability to respond? As you mentioned, we could expect a rate cut perhaps in October, and that's, of course, the biggest fallout of this. What is your assessment?
That's right. So this year, the inflation will remain stubbornly high. If you look at the University of Michigan's survey for inflation expectations, actually, they have risen up to 5% for 12 months out. And so that, in conjunction with the recent rise in the oil price, which I think could continue if Iran doesn't respond to Trump's ultimatum, to have a new nuclear deal, it all does mean that inflation is going to be on the sticky side, and next year will be better. So we do look for 2 rate cuts next year, but just 1 this year.
Right. Let's also discuss the broader implications of this, of course. And given that Europe and Japan are already showing signs of market stress, how do you see global markets reacting to Trump's reciprocal tariffs?
Well, historically, if the S&P 500 index goes down very, very quickly, then everything goes down, except, very far-flung, uncorrelated markets. Unfortunately, India is not one of them. It's a big open market. But if the S&P just drifts down slowly, like it's been doing so far this year, I mean, it's down 5% in the first 3 months of this year. That's a manageable decline. If it continued to go down at that rate, then other countries' markets can go up. I'd also just point out that historically, April is the second strongest month of the year for the S&P. And in the years when March went down 3% or more, on average, April was up 6%. In all the years since World War II. So as bad as things look now, it wouldn't surprise me if April turns out to be a positive month.
All right. Well, of course, for now, it appears to be a wait-and-watch scenario. We'll, of course, continue to track this very closely. Mark Matthews, thank you so much for joining us on World Business Watch with your insights on this.